If you've been watching the metals market this morning, you probably felt that little jolt of confusion. Because what's happening in silver right now? It isn't normal. I'm talking about a metal that just suffered a historic 34% crash. And now, on Monday, February 2nd, it's sliding again, hovering around that $80 to $82 zone, while traders scramble to figure out whether the worst is over or just getting started. But here's the part most headlines aren't telling you. The real trigger behind this move isn't panic, it's policy. And stay with me, because if you understand this moment, you'll start recognizing these setups long before the crowd does. Your job right now isn't to guess the bottom. Your job is to understand the machinery that's moving this market, because once you see it, you can't unsee it. Before I explain what caused this, let me teach you something most investors learn the hard way. Markets don't move because of what's happening today. They move because of what traders think is coming next. Think of the market like a giant thermostat. It doesn't wait for the room to freeze. It adjusts the temperature the second it senses a draft. That draft could be a policy shift, a geopolitical rumor, a change in sentiment. Doesn't matter. What matters is the market reacts to expectations, not reality. Right now, that draft is a sudden shift in expectations around U.S. monetary policy. When President Trump nominated Kevin Warsh as the next Fed chair, markets didn't just shrug, they recalibrated instantly. Warsh carries a reputation for discipline, less accommodation, tighter liquidity, fewer easy dollars sloshing through the system. And silver? Silver loves easy money. When liquidity tightens, speculative assets start sweating. Here's what you need to know. Precious metals often rally when investors expect lower real rates and more stimulus. Remove that expectation, and the entire narrative begins to wobble. So what does that tell us? It tells us we're not watching a market meltdown. We're watching a repricing event. And repricing events follow a pattern. Now here's what's actually happening under the surface. Let me break down the sequence, because once you see it, you really can't unsee it. There are layers here, and each one feeds into the next. Primary driver, policy repricing. Traders are rapidly adjusting models to reflect a potentially stricter Federal Reserve path. When Warsh's name hit the wires, bond markets immediately started pricing in higher terminal rates. That pushes yields higher, strengthens the dollar, and suddenly holding a non-yielding asset like silver becomes less attractive. You're not getting paid to wait. You're not collecting interest. You're just sitting there, hoping for appreciation. And when the dollar strengthens, it takes more foreign currency to buy the same ounce of silver, which dampens international demand. So you've got this feedback loop starting to build. Higher rates expectation, stronger dollar, weaker precious metals demand. That's not emotional selling. That's structural repricing based on forward-looking monetary policy assumptions. It's cold, it's calculated, and it happens fast. Secondary confirmation. Geopolitical cooling. Renewed U.S.-Iran talks are quietly draining the fear premium from global markets. Safe haven demand thrives on uncertainty. When tensions flare, investors pile into gold and silver as insurance. Take away the immediate threat, and that insurance trade starts looking expensive. Why pay a premium for protection you don't need? So you've got capital rotating out of safe havens and back into risk assets, or simply sitting in cash, waiting for clarity. This isn't a massive driver, but it's confirmation. It validates the policy repricing story. When two independent factors point in the same direction, that's when markets move with conviction. But here's where it gets mechanical, and honestly, a little brutal. Silver's rally had become overcrowded, too many leverage positions, too many fast money traders chasing momentum. So when volatility exploded after the crash, futures exchanges increased margin requirements. Translation? Traders had to post more cash immediately or liquidate. And here's the thing about margin calls. They don't care about your thesis. They don't care if you're right long term. They demand cash now. So forced selling begins, and it feeds on itself. Prices drop, margin calls hit, positions unwind, prices drop again. It's not emotional, it's structural, it's pure mechanics. And this is the part that should make you pay attention, because most people think crashes happen and then recover quickly. But forced liquidation often continues even after the original panic fades. Why? Because leverage doesn't unwind in a straight line. It unwinds in waves. First wave is the initial shock. Second wave is the margin calls that follow 24 to 48 hours later. Third wave is the funds and institutions reassessing risk allocations and cutting exposure even at lower prices. Each wave pushes prices lower until finally, the leverage is cleared out of the system. And that's why today matters so much. This is the phase where markets decide, stabilization or deeper consolidation. This is the exact same playbook we've seen before. Go back to the 2011 silver spike. Silver ran from under $20 to nearly $50 in a matter of months. Parabolic rise, massive retail participation. Everyone convinced it was going to $100. Then exchanges hiked margin requirements 5 times in 8 days. 5 times. And what happened next? Violent correction. Silver dropped 30% in a week. Same pattern. Margin hikes, forced liquidation, cascade selling, or look at the 2020 gold liquidity crunch. March 2020, when COVID hit and markets froze, even safe havens got sold. Why? Because funds needed cash. They weren't selling gold because they hated gold. They were selling because they had redemption requests and had to raise liquidity fast. Sometimes the safest assets get hit the hardest simply because they're the easiest to sell. Zoom out further and you'll notice a repeating rhythm. When policy expectations shift suddenly, crowded trades don't gently rotate. They snap. Every time this pattern shows up, the larger story isn't the crash itself. It's the transition from euphoria to price discovery. And price discovery can feel chaotic. It can feel irrational, but it's not. It's the market figuring out what something's actually worth when leverage comes off the table. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be an overreaction? Absolutely. Markets misprice things all the time. Sentiment swings too far in both directions. There's already chatter about manipulation, about big players shaking out retail, about orchestrated takedowns to benefit commercial shorts. Could that be happening? Maybe. I'm not here to say it's impossible. But here's the thing. Blaming shadow forces doesn't help you navigate risk. It doesn't give you a trade setup. It doesn't tell you when to enter or exit. What matters is liquidity, positioning, and expectations. Those are measurable. Those you can track. Focus on what you can measure, because whether you're bullish or bearish, whether you believe in conspiracies or pure market mechanics, the tape is telling you one simple truth. The market is repricing the future. And your opinion about whether that repricing is fair doesn't change the fact that it's happening. There are probably 3 types of people watching this right now. Let me talk to each of you. First, you might be the long-term believer. You see silver as a monetary hedge, maybe even an industrial powerhouse tied to solar panels, EVs, electrification of everything. You've been stacking for years. You believe the fiat system is broken and hard assets win in the end. And honestly, your thesis doesn't evaporate because of one violent unwind. The fundamentals you believe in, money printing, industrial demand, supply constraints, those didn't disappear overnight. But if that's you, patience is your edge. Let the leverage clear. Let the weak hands flush out. Durable bottoms rarely form during margin cascades. They form after. When volatility contracts, when volume dries up, when nobody's talking about it anymore. That's when smart accumulators step in. So don't panic. Don't capitulate because price moved against you. But also, don't blindly average down into a falling knife while forced sellers are still active. Wait for stabilization signals. Second, maybe you're the tactical trader. You're not married to silver. You're asking, is this the bounce zone? Can I scalp a recovery trade here? Fair question. What you want to watch isn't just price, it's volatility contraction. When ranges tighten and volume normalizes, that's often the market telling you forced sellers are exhausted. You want to see silver hold a level for multiple sessions without breaking lower. You want to see derivatives markets calm down, implied volatility dropping, option spreads tightening. Those are signs that the mechanical selling pressure is easing, but be careful. Don't assume the first bounce is the bottom. Dead cat bounces are real. You might get a 10% to 15% relief rally that still gets sold into. Your edge as a trader is risk management, tight stops, small position sizes until the trend clarifies. Don't hero trade this. Third, you might just be trying to make sense of the chaos. You don't have a position. You're just watching and learning. And if that's you, remember this principle. Markets overshoot in both directions. The same emotion that drove silver too high can drive it temporarily too low. Extremes create opportunity, but only if you're patient and disciplined. Use this as a case study. Watch how the next few weeks unfold. Notice what signals precede stabilization. Notice how sentiment shifts from panic to indifference to cautious optimism. That cycle repeats in every market, every asset class. Learn the rhythm now, and you'll recognize it faster next time. So here's what I want you to answer in the comments. Which type are you? Long-term holder, tactical trader, or observer learning the game? And what's your biggest question about what happens next? I want to hear from you because your perspective helps everyone learn. Here's where I stand. I'm not panicking, and I'm not blindly buying dips. I'm observing. I'm waiting for confirmation. Let me tell you what I'm personally watching. First, I'm watching real rate expectations. If inflation expectations stay stable or tick higher while nominal yields keep rising, that means real rates are climbing. And rising real rates are kryptonite for non-yielding assets like silver. If that trend continues, metals stay under pressure. Second, I'm watching futures positioning for signs that leverage has truly flushed out. The Commodity Futures Trading Commission publishes weekly commitment of traders reports. When speculative long positions drop significantly and stabilize, that's a signal the crowded trade has cleared. Third, I'm monitoring geopolitical tone because fear can return faster than anyone expects. One headline, one missile strike, one unexpected escalation, and safe haven demand comes roaring back. So I'm not assuming calm lasts forever. Based on my analysis, this drop wasn't random. It was mechanical, it was structural. The fundamentals behind silver, industrial demand tied to green energy, monetary hedging against fiat debasement, they didn't vanish overnight. But the easy money narrative, that's being questioned. When a new Fed chair signals tighter policy, when yields rise, when the dollar strengthens, the macro backdrop for precious metals shifts. That doesn't mean silver goes to zero. It means the path higher gets harder. It means you need stronger catalysts to overcome headwinds. And right now, those catalysts aren't obvious. Maybe they develop, maybe inflation comes back hotter than expected. Maybe the Fed pivots again, maybe geopolitical risks escalate. But right now, in this moment, the wind is blowing against silver, not behind it. If history rhymes and silver finds a floor in this $75 to $85 zone, the move that follows could be significant. Not because I'm predicting it, but because that's what happens when leverage clears and fundamentals reassert. Markets don't stay oversold forever. They don't stay in panic mode indefinitely. Eventually, value buyers step in. Eventually, the narrative shifts. But timing, that is the hard part. And that's why I'm not rushing. I'm watching. I'm waiting. I'm letting the market show me stabilization before I make a move. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Form your own conclusions. My job isn't to tell you what to do. My job is to show you how to think about what's happening so you can make informed decisions for yourself. If you made it this far, you're not looking for hype. You're looking for understanding. That mentality will serve you well. Markets reward patience, discipline, and pattern recognition. They punish emotion, leverage, and guessing. You're building the right foundation. Keep going. If this analysis helped you see the silver move differently, share it with someone who's confused or panicking right now. They need this perspective. And if you want more breakdowns like this, subscribe and turn on notifications because these moments don't announce themselves. They happen fast. And the people who understand them early, they're the ones positioned before the next major move begins. Stay sharp out there. Think critically, verify the data, and make your own decisions.